All right, so welcome back to the show. Sorry about that. Just had to take a quick break. So just as a recap for those that have either missed the segment or just tuning in or just had to take a small break. Today we're talking about essentially keys to become a successful investor. We talked about the first step is you really need to educate yourself. So you need to start reading books and going on sites like Investopedia, checking out articles, newsletters, things of that nature, seminars. So those are some of the things that you would want to do in order to, that's like the first step to becoming a successful investor. Read books, read articles. It's very important to educate yourself when it comes to this, because in order to become a successful investor, there's no way you're going to do that if you don't know what it is that you're doing. So just something to keep in mind there. So educate yourself and keep in mind that investing is only risky if you don't understand what it is that you're doing. So just very important note there. Now, another thing you want to do, as we were talking about, is setting attainable goals. So set a goal saying, for example, you want to invest $100 per month because that's what your budget allows. And then also establish a rate of return every year. So perhaps you want to achieve 8% annualized returns every year. Maybe you want to just benchmark the market, which grows at about 9% on average every year. And then understand your time horizon. So understand whether you're a long-term versus short-term investor. Me personally, I'm a long-term investor, even though this, I mean, basically the younger you are, usually the more short-term you are, which kind of is crazy, but usually short-term investments provide the highest returns because it's a little riskier. So understand your time horizon. So sit down with a financial professional who can tell you whether you're long-term or short-term, what best fits you. And understand that younger people have a longer time horizon than older people, so they can afford to make riskier investment decisions. So a younger person can be in a market, not necessarily longer per se, but they can take a little bit more risk. They can start maybe doing some day trading. They can start doing some short-term trades that a typical older investor wouldn't be able to do because of age and because of the fact that they're approaching retirement. You want to understand your risk tolerance. So it's very important that you understand your risk tolerance. Younger people tend to be more risk-seeking or aggressive as opposed to older folks. Older folks tend to be more risk-averse. So risk tolerance is how much risk you're willing to take in the market. And then always keep your liquidity needs in mind. Liquidity is simply a measure of how much money you need within, let's say, a 1 year time span. It's usually a short-term need of money. So liquidity is how liquid are you? How quickly can you turn something into cash? Or how much cash do you currently have? So always keep your liquidity needs. Perhaps you're looking to buy a house, so maybe you can't invest that much into the market. So definitely keep your liquidity needs in mind. And then maybe you want to buy a new home, perhaps, next year. So you need to put more money towards saving or low-risk investments. Or maybe you don't need liquidity because you're making a lot of money and you can afford to be in the market. You don't have any liquidity needs coming up. So just keep those things in mind. And then ensure that you have an adequate savings plan. Or adequate savings in general. Or at least some type of savings plan. So let's say that you need $6,000 per month. I'm sorry, $6,000 in your account in order to be safe when it comes to your savings target. Then you can say, okay, for the next 60 months, I'll save $100 per month. As long as you have that, it's automated and it's going, then you should be perfectly fine. But in order to invest comfortably, and I mean comfortably, someone who can truly enjoy the market, you do need some adequate savings on hand And in order to do this, you can take a few approaches. You can establish a rainy day fund, which I highly recommend. A rainy day fund is simply you're reserving 3 to 6 months worth of your expenses in the form of cash, and maybe some very short-term, non-risky investments. So essentially what you're doing here is you basically have 3 to 6 months worth of your expenses saved up in a bank that you are, in the event of maybe a crash or an event of something bad happening, you are able to take that money out and do something with it. So just a few things to note there. And then ensure that your high interest rate debts such as credit cards are paid off, or you have a plan of action to pay it off. They can truly diminish your ability to invest in the market, in real estate, whatever it is. These high interest rate credit cards that the interest just keeps piling on and piling on, it can be very, very, very dangerous. So it can definitely diminish your ability to invest and your purchasing power due to the high interest. If anything, this is the time to start paying off some of those high interest rate loans, or taking out a lower interest rate loan to paying off the higher interest rate loan and just paying the lower payments over time. And then also protect yourself, of course. So in order to have adequate savings, in order to have a good plan of action, you need to protect yourself. So be sure you have the necessary insurance policies in place, such as your home, auto, health, disability, and most important, your actual life. So make sure you have life insurance in place in the event something bad happens. There are some policies that allow you to build what's called cash value in the policy in case you need a rainy day fund, or if you need some money. The money in the policy can accumulate over time. And then seek help of an insurance professional to review these items. Highly recommend it. One of my companies, Badu Life and Health, what we do is we do provide insurance consultant services, things of that nature, helping you get the right amount of coverage for you and your family. So those are the 3 ways to ensure you have adequate savings: is to establish a rainy day fund, ensure that your high interest rate debts such as credit cards are paid off, and then also by protecting yourself. So very key ingredients there. Along with that, take advantage of various retirement accounts. These are usually tax advantage retirement accounts, so it's definitely best to take advantage. And especially the ones that come with a match. So some retirement accounts come with a match, an employer match, such as a 401k. Some employers might match you 50% if you contribute up to 6%. That's an extra 3%. Extra 3% that the employer is now going to give you for free, basically, assuming you meet the vesting requirements. And I would say anything outside the match, try your best to contribute on an after-tax basis. So take advantage of the Roth accounts or the after-tax accounts, because tax rates are pretty low right now. So it's best to take advantage of that by essentially contributing on an after-tax basis. That way you're paying the taxes now, and you don't have to worry about paying the taxes in the future. Once you obtain adequate knowledge and have the proper savings plan in place, you can now explore different options and set up an investment game plan. Before we get into the actual investments themselves, let's just recap what we've talked about so far. The first step to becoming a successful investor is to educate yourself. You must go through education. Just like somebody who obtains a master's degree in order to teach a course, it's the same thing here. You need to educate yourself first before you get into the market, or before you get deeply into the market. Read books, read articles, attend seminars. Anything you can get your hands on that increases your investment education is highly recommended. This is exactly what I did. I didn't just jump in the stock market. I didn't just jump. Eventually you do have to jump. That's very important. But before you jump, you need to educate yourself. I actually went through investment courses before I bought my first piece of stock, which was a few shares in General Electric, or GE for short. So you need to educate yourself. That's the very first step. Before you invest in anything, please make sure you're educated. At a bare minimum, know what it actually is, know what the terms are. You don't have to be an expert at it. Just know the bare minimum, if anything. And then, of course, try your best to advance your knowledge. Try to become an expert or become a master at that knowledge. So you need to educate yourself by first becoming familiar with various investment terms, starting to set attainable goals. So always set goals. And then also you and along with those goals, you need to understand your time horizon, your risk tolerance, your liquidity needs, things of that nature. So once you've educated yourself, and then once you've started setting attainable goals, then you need to ensure your savings amounts or savings plan is pretty adequate in order to really get into this game of investing. So once you've done that, now we can talk about the actual investments. Now we can actually get in and start investing the money. So I won't go through all of these as far as specifics or details. I do have different segments that go through these breakdowns in a lot more depth. But you have long-term investments and then short-term investments. Long-term investments include dividend-paying stocks such as General Electric, Apple, AT&T. So companies like that pay what's called dividends, which are quarterly checks to your bank account as a thank you for your contribution. So companies, for example, back in the day, AT&T, for example, was paying, let's say, 5%. So every quarter, you would get about between 1 to 1.5% return on your investment as a thank you for contributing to the AT&T fund. The next one is ETFs, or exchange traded funds, which are simply a pool of stocks. So you're investing in a pool of stocks. They're usually lower costs, lower fees, and you have a lot more flexibility as opposed to its partner or its ally or whatever you want to call it, mutual fund. Mutual fund is a pool of stocks as well, but it's typically with higher fees, higher maintenance, and tends to be looked down upon nowadays. You can buy and hold Bitcoin and other digital currencies. Won't get into that, but Bitcoin is a form of a digital currency. You can buy cash flowing real estate. This is my favorite one. My favorite investment on the planet is a real estate piece of property that is cash flowing. A 10 unit, 12 unit, 15 unit, even a 3 unit. Anything that's cash flowing, putting money in your pocket each and every month, is something that I think should be part of anybody's investment portfolio. Cash flowing real estate, absolutely love it. I have a full segment where I talk about this. Within the last 2 segments, we did talk about the 6 reasons why you should own real estate. And cash flow was the number one reason. So cash flow in real estate is definitely a great long-term investment option for you. You can look into peer-to-peer lending, such as sites like Lending Club. Those are also pretty good options. You can look into bonds. Usually that's for the lower risk investor who is looking to invest for the long term but take a little lower risk. Bonds usually have lower returns than stocks. You can look into peer-to-peer car rentals. So there are sites such as Turo where you can lease your car, or you can put your car on the platform and somebody can rent it out for you. You can actually turn it into a business. This is how my second business was actually formed. You can look into permanent life insurance. Very critical for you to seek this. You have 4 types: whole life, universal life, variable life, and then variable universal life. Won't get into the details, but basically you're investing a certain amount of money each month into the policy, and the money, a significant portion of it gets invested into, let's say, the stock market. Annuities, not really big fan of, but annuities essentially allow you to contribute a certain amount or to front the money, and then you can turn on an income stream for the rest of your life. It's like a pension, basically. So those are long-term investments. These are long-term horizon. You're in it for the long run with these investments. And then you have short-term investments. I don't do any short-term investings or investing, really, because I'm in it for the long run. I understand the long game that you have to play when it comes to investing. But you have day trading stocks and Forex, Bitcoin, things of that nature. So anything that's short-term, meaning less than a year, I would say short-term to me is anything that you're doing within less than 6 months. That's just my definition. So if you're day trading stocks, you're picking stocks, you're trading forex, things of that nature, that's all short term. If you're doing wholesaling, so as a real estate investor, you're wholesaling real estate, that's short term. If you're doing fix and flip real estate, where you're buying a property at a pretty low price, you're fixing it up and then selling it to somebody for a profit, that's fix and flip, that's short term. Me, I don't like short-term investments because I can make way more money focusing more on my long-term investments. That's just my perspective. Short-term is like a job to me. I would much rather focus on my real job as opposed to this whole wholesaling, day trading thing. I used to day trade. I used to wholesale. I used to do fix and flip, but I don't do those things anymore because I understand that the value for me that I've seen, most of the value is through these long-term investments because I know the money is going to grow over time. So you really need to you have to explore the different options, see what suits you best. Me personally, I own dividend-paying stocks, ETFs. I don't own any mutual funds. I'm not a fan of mutual funds. I have some Bitcoin, so buy and hold Bitcoin. I have cash flow in real estate. I do some peer-to-peer lending. I do not own any bonds because I'm just not really fond of. I own peer-to-peer car rentals. I own permanent life insurance. I do not have an annuity just because, I don't like the old school stuff. So mutual funds, bonds, annuities, that's just not for me. I just never found it too attractive. I would much rather have something that can grow faster and is a little more stable than some of these vehicles. Not necessarily even more stable, but just I understand the investments that I'm in more than any other investments that's out there. So I choose to invest in what I know, which is one of Warren Buffett's rule of investing. Once you start exploring different options, you need to begin implementing a plan and allocating funds based off your risk tolerance and your time horizon. So, for example, maybe 50% is going towards dividend-paying stocks, 30% to ETFs, and 20% to peer-to-peer lending. Maybe 60% to real estate, 20% to bonds, and then maybe another 20% to buy and hold Bitcoin. Whatever it is, it's up to you. If you want specifics, if you want one-on-one, then please be sure to consult an investment advisor. I can certainly help you out with some of this stuff, or I can at least point you in the right direction. So implement. Remember, unless something is implemented or unless you've done implementation, you basically, not that you haven't done anything, but nothing truly matters until you implement it. So it's like an idea that's stuck in your brain but never actually manifests and comes to fruition. Just something to keep in mind. It's a lesson that I've learned, and that you really need to take action when it comes to these things. So you can be listening to this segment, gaining all the education in the world. Gaining tons of education, but if you don't act, if you don't implement, it means nothing. It means absolutely nothing. So just wanted to point that out really quick. Now, once you've done that, once you've began implementing, you also want to monitor. Always monitor your plan, see how it's performing. So analyze your performance over time, as well as reallocate an asset. So as you get older, you should be in less risky investments. So you always need to rebalance your portfolio, they call it, as you're getting older or as your investment needs or your financial needs change. Always monitor. It's extremely critical. It's not as critical as implementation. However, I do think you need to monitor it to see how you're performing and see what needs to be changed. Track your rates of return, and then also compare them to your targets or compare them to your peers. Whoever it is you can compare them with, try to do some sort of comparison. Now, here are my tips that I'll leave you with. Never go it alone. So do not do this alone. Always have good advisors on your team, whether you need to pay for them or not. Please make sure you have advisors, somebody who's going to guide you through this process. I didn't learn investing on my own. Although I learned a ton from YouTube videos, I still sought out mentors, and of course I was out in the field actually doing some of the investing. So have good advisors on your team. Don't just hand your information to an advisor. Don't just say, hey, financial advisor, here you go, I'll see you in a year. I mean, monitor it at least every month or even every 6 months. Just continuously monitoring it, see how you're performing, and be proactive. Be very proactive when it comes to this stuff. I understand not everyone is interested in investing, but I guarantee you, you're interested in making money. So what's more important? You actually taking maybe 10 to 15, maybe sometimes 30 minutes every month to monitor your investments, or potentially losing money and not monitoring it because you claim you don't have quote unquote time or interest in your own money. It makes no sense to me. So don't just hand your information to somebody and just call it a day. And then they should only serve as a guide or as a resource, somebody who's actually guiding you, giving you the missing information that you need, and helping you, showing you how to do some of these things. So it is very important that you keep that in mind and continuously educate yourself. Don't just pick up a book, read it, invest, and then stop learning. This is a continuous learning process. You must learn every day. You must learn every week. For me, I'm always learning, not just because I'm in this industry, but because I truly care about my money and I truly want to grow the money. And then watch out for taxes. That's where I usually come in. So always keep taxes in mind. Seek the help of a tax professional, such as myself. Always run your numbers. Don't just take somebody's word for it. Run your own independent numbers and then compare and see if they're close. If they're close, then hey, chances are it's not that it's a good investment, but you probably are on the right track when it comes to that. And then do some form of automated investing, such as Acorns to start with, or even just as a continuous investment. I recommend starting off with $5 per day. $5 a day invested over 40 years, growing at a 7% return on investment, is roughly $700,000 in your account. That is very, very, very powerful. So $5 a day, I know you can invest $5 a day. I mean, there's nobody on this planet, unless you're homeless or unless you're going through something very serious, nobody on this planet that can tell me they can't invest. They cannot invest $5 a day. Nobody. It doesn't matter how many kids you have, how much hardship you're going through. $5 a day, you can invest it. Trust me. If you did that over a 40-year time span, you'd have $700,000 in your account. That goes to show you the power of compound interest. So do some form of automated investing. You can also do virtual trades, so practice trading. I know TD Ameritrade has a platform, Thinkorswim. There's other platforms out there as well. So if you need practice, hey, practice makes perfect. Michael Jordan didn't become the best basketball player by not practicing. He practiced. So maybe do some practice. It's not a bad idea at all. I mean, if you feel ready after your education to get in, then that's fine too. Do some practice. I actually practiced trading before I actually got into the stock market. I went through a stock market course that actually taught me how to invest in stocks. So everything I'm telling you, I basically did the same thing. Don't put all your eggs in one basket. I mean, if you know something really well, you can put most of it in there, but don't put 100% into any asset class or investment. Cash is king. Keep that in mind. Don't forget to keep your reserves up to date. Don't dive in with both feet, as Warren Buffett would say. Dip your toes in the water a bit. Essentially, start small, but think big. Don't just dump all your money in at once. Start small, start in increments. And then once you feel comfortable, then you can go ahead and go big. Last but not least, take advantage of technology. There's so much technology at our fingertips. We have so much technology that is at our fingertips right now. And we should absolutely be taking advantage of it. Take advantage of your mobile apps. TD Ameritrade has a state-of-the-art mobile application. Robinhood is also great. Acorn, Stash. Take advantage of those sites because they're truly beneficial, not just for the investment, but also for the education that these platforms provide. Guess what? For free. 100% free education. So nobody can complain. And if you need education, check out my website, jeffbadu.com, jeffbadu.com. There's no excuses in 2020. I don't want to hear it from anybody in 2020. We've had an opportunity to do a lot of things. So if you're behind and you're trying to blame somebody, then I think you should be pointing the fingers back at yourself. With that being said, thank you all for tuning in to WJC 98.3 FM, your voice, your music, your station. My name is Jeff Badu, and I look forward to continuously delivering you all some content. Thank you.